So I say that for the third time, then I click on it and all three comes up. So I hope you found the one in Moodle. If you click on one, it's not coming up, click on the other one. This one should definitely have the date on it of 2/21/19. And some of them just had tax or tax class, so I was trying to set them up again. So that's where we are. I think Clayton had a dental appointment, and Cole texted me that he was sick today. Terry always live streams, so that leaves Hillary and Jonathan. I haven't heard from Jonathan. Jonathan owed me a test in cost, and so does Savannah in cost. Now, last night, let's see, Hillary, you made it for taxes, didn't you? And Jonathan and Cole and Sarah and Clayton. So we had 5, but we canceled the 6 o'clock people and the 6:30. And Hillary, what time did you get out there? About 5 or 10 after 6. So tried to get everybody out a little early. It was raining, not snowing. It wasn't dangerous, but we canceled about 10 people. So we did about 24. So already we've done 100, about 130 in 3 nights. But we're doing okay. Hillary left out last night. Everybody I gave her, when her number was ready, they just had one W-2. So how many did you do last night, Hillary? 4 or 5? 5? All right. Now, be careful. We've got one we messed up the first night. Be sure when you read that interview and see if they want to be claimed on their own return or somebody else's. We got one that's a mess. We're going to have to do amended return because of clicking or not clicking a box. So be careful with that, especially if it's a young person or a student. Are you going to claim yourself? If they say no, don't check that they're claiming themselves, whatever that box is. So please be careful with claiming somebody else. All right. Now, you didn't make the class yesterday, did you? Tuesday? All right, we're just going to review a little bit of what we did Tuesday. Now, I've asked you on chapter 14 to be working the even problem. That's ongoing. Now we've got to cover chapter 13, 11, 12, and 13 before we do corporations. So I'm going to make quick work out of some of these because an accounting methods or accounting periods, this is a 2017 edition of PowerPoint, not the new 18 because it's still not working. But we know we've got fiscal year and a calendar year. And a calendar year, we can make it up to 53 weeks if we need to. C corporation may select a tax year that represents their business cycle, March 1st to March the 31st of next year. And as an individual, us, let's keep a calendar year. And if you change a accounting period, you've got to request permission to change from a calendar to a physical or a physical to a calendar and get this form from IRS, which is 1128. All right, here are the methods we looked at on Tuesday. We know the cash method. You folks are accounting majors. You know, cash method is what it says, it's cash. And the accrual method is what it says, it's accrual. Now, there may be a few exceptions to the way accounting does it. In other words, if we prepay rent for 5 years in advance, even on the cash basis, can we take all 5 years or just one? Okay? And so we have to look at a few of the prepaids and a few of the cash payments in advance on our revenue. Now, the hybrid method is a combination. You use only your accounts receivable and accounts payable. accounts receivable and accounts payable. You can do those on the accrual basis and everything else cash. In other words, if you have a selling type business, you've got accounts receivable and a credit to sale. And if you buy merchandise inventory, you make credit accounts payable. You can do those two things on the accrual, everything else cash. All right, just to review this a little bit, I thought I'd lost it there for a minute. Uh, New taxpayer can pick any accounting method. Cash basis taxpayers, you've got to have under 1 million gross receipts. And no cost of goods sold and gross receipts less than 10 million. Now, if you had a cost of goods sold, it's a selling business. This would have to be some kind of service business. But cash receipts. Now, I did cash receipts with a lot of trucking companies. They received the money, I counted. Some mining company owed them for a week, I didn't count it unless they got the check. That's simple. They would go in and buy $3,000 to $5,000 worth of tires on December 31st. They paid cash, I counted it as an expense, even though they weren't going to use the tires until the middle of the next year. You got to recognize income. Actually, constructively received means you're carrying a check around in your pocket, or you got a right to go pick it up, and you have. We looked over there. We still have to depreciate. You still have to depreciate, or deplete, or amortize. That's called capitalization. Now look at this one under the cash method. You pay rent, let's say $5,000 a year, 3 years in advance. Now, are you going to take $15,000 off as rent expense? Here it says it must be capitalized and amortized as goods and services are used if the life of the asset extends substantially beyond the end of the period. Now, in other words, you take $5,000 of that this year, whether you're on the cash basis or the accrual basis. Okay? And we always know that even on the accrual basis, you give the church a check on December 31st, you can count it as a contribution. Or if you let the church use your credit card for a donation on December 31st, you can count it as a contribution. If you pay your hospital bill, you can count it as medical if it's paid on December 31st. So checks and credit cards are the same as cash. All right. Accrual method, income recognized when earned. They've got an all advance test. I mean, if you've done the work, you've earned it. That's an all advance. All right. Can defer recognition if prepaid for services. Must recognize revenue associated with service provided in year one. Remainder must be recognized in year two. Now, a lawyer might take money in advance, and he don't have to count it all. You can deduct if the all advance test has been met, economic performance. So, if you paid your rent, if you owe for your rent, you can deduct it on the accrual basis. You've used it, that's all advance. The economic performance test has been met. So you know these two methods. Now, inventories, we discussed that a little bit the other day, and I showed you a 1040, not a 1040, but a Schedule C, or a partnership or a corporation. They all have on there inventory valued at cost, lower of cost or market, and then other. Now, we know cost is a specific inventory method. You would use cost on furniture, diamonds, cars, all right? Now, you can use lower of cost or market probably also on diamonds if you want to separate them that way. But your inventory, you may have paid lower of cost or market, and make that a C. You may have paid $10, but you go out there and buy it for $9, so you're going to value it at $9. So, but then the other methods, LIFO and FIFO, come into play. All right, if you're building something, we got materials, labor, and overhead, don't we? So any factory repair to it, utilities, and rent, insurance, all that goes into making that product. Materials, labor, and overhead. Factory administration is your supervisors and foremen, payroll, taxes, inspection, rework. This is all overhead. All that is overhead in a factory. Every bit of it. And you've got labor and materials added in. All right, now here is your lower cost to market. This is your cost for Pacific. Now the other three methods you have had. You have had FIFO, LIFO, and average. Now you've had those under two scenarios. You've had these three under two scenarios. You've had them under perpetual and periodic. Now also in this chapter about revenue. Now Hillary, are you in intermediate?
No, I've already had it.
You've already had it? Okay, come in, Joe. Hillary, are you working anywhere? Where do you drive from?
Wyoming County.
From where?
Wyoming County.
And how many days a week you come down? Just Tuesday, Thursday?
Tuesday, Thursday, and Wednesday for tax.
Come Wednesday night for taxes? I wonder when they do come for you. Yeah.
I don't know how many hours she wants.
Yeah. Well, Hillary could come down on Tuesday, Wednesday, Thursday without extra drive.
Yeah. Like I say, I don't know how many hours she needs. She didn't tell me. I figured it'd just be best that she.
Now, Terry's pretty good too, but she's up in Bedford. She's on street today.
Well, like I say, you look the crap over, you call her back.
I'll look them over. If I can't get Hillary, I'll go down to my county one club. The vice president of finance on the Hill, Sheila, needs somebody to work study. And it would probably be a pretty good thing. I could even do the internship for you. Are you interested? Hillary, give me your, on a piece of paper, write down your email and your telephone number. And you are a junior, right?
I'm a senior.
Senior? That's okay.
Hopefully I'll get to graduate next May.
May or next December?
I didn't have quite enough to do it this time.
Okay, write everything down. You'll be here then another year. And you don't have any commitments at home or anything, no kids and, oh, that's right. When's that baby due?
July.
Ooh, okay, you could work out the rest of, let's see, this term,
I mean, I'll still be going. I'll be up here next semester either way.
summer. You might still work some in the summer and then all fall. All right, I'll give that to her though, Hillary. You all, she contacts you, you all can take it from there, okay? And I'll let you know something, okay? All right, direct and allocated overhead are allocated to contract. Costs not associated with a specific contract are deducted. That's selling, marketing. Interest expense must be capitalized and paid. Now, long-term contract, you will get this in intermediate. You've already had intermediate? Do you remember long-term contracts? Now, what I
It's
mean,
been a little while, but yeah.
all right, what I want you to look at though, you may have seen the installment method, you may not have. But on this long-term contract, it's not showing it good here, but percentage of completion. This was called the percentage of completion method. All right, income is reported as work progresses. Now, you've also got a completed contract method. Costs are capitalized and deducted from revenue when the contract is completed. All right, so we'll look at those and work a little problem in percent of completion method. Now, we're going to look at the installment method. This is pretty easy. Compute the gross profit from the sale. All right, I'm going to sell a piece of land for $15,000. It cost me 10. All right, Hillary, you're the only one here. What is the gross profit? Sure, it's 5,000. Determine the contract price. It's 15,000. Compute the gross profit percent. All right, divide 15 into 5. Your sales price into your gross profit is gross profit percent. What is that? 33 1/3. All right. Compute the gain to be reported in this year of sale. And then compute the gain to be reported in subsequent years. All right. So let's say the year we sold it, they paid us $2,000 down. How much of that's gross profit? What is 33 1/3% of $2,000? I hate those 33 1/3, but that's the example I gave you. All right, $667 is how much you'll report as profit this year. So the gross profit method, it's easy, it's the installment method. And you have a nice little old form to put it on, but that's too little to show you much about it. All right. And you can do that. I've done this. I even did this once for myself. I sold some property installment method. And I'm sure TV dealers and furniture dealers can sell on and use the installment method for taxes. Now, inputted interest, okay, let's say you hear of an advertisement. This item cost you, this piece of furniture cost you $5,000. We'll sell it to you for $5,000 with no interest. And we're going to sell it to you on the installment plan for 4 years. Do you really think there's no interest in that $5,000? How much would they take as a cash price? There is inputted interest in there, and that's why you got to work it out and count it as interest expense. There is. Now, a bond, if you sell it at a discount or premium, is there any kind of inputted interest? Loans may have inputted interest. Hey, I'm going to give you $1,000. You have to pay no interest. I think it's on selling things more than I do a loan. All right, we will work on those. So I want you to be working the even problems in chapter 11. Now we're going to skip over to chapter 12 too. Now, once I get these 3 chapters behind us, 11, 12, 14, I'll give you a test, of course. Now, reason I went over that chapter 5, we will work some problems, but you've had to accrue on a cash basis. You've had LIFO, FIFO, and weighted average inventory. Well, that's crazy. This worked a minute ago. 2000. Not making sense. It opened up one chapter and don't want to open up another one. Well, there it is. Let's see. There it is. Yeah, that's okay. But it's for 2017 taxes, what it's about here. But this stuff did not change. Now, what chapter 12 is doing, it's wrapping up those property tax transactions. it's wrapping up maybe casualty losses and other things. So it's wrapping up some things we didn't wrap up in the personal taxes. So we're going to have involuntary gains in this chapter. We're going to have like kinds exchange in this chapter. We're going to have the principal residence in this chapter, with no taxes. But that's the three things I want to do in this chapter: like kind, involuntary, personal residence. That's chapter 12. It's a must. So when we get through chapter 12, 13, 14, that's all of personal taxes. Now, when I say personal taxes, we don't need inventory methods for personal taxes, do we? That's chapter 11. So that's business taxes. We don't need accounting periods for us as individuals. So that's business taxes. So we are covering business taxes. Even the chapter on depreciation was business taxes. Now, it's hard for me to count this chapter as business taxes, even though businesses have these transactions. All right, we're going to have these 1231 or 1031 like kind exchanges, involuntary, and self-rent. That's the three that I want to talk about. Now, a lot of these may be non-taxable. Sale of a home, usually non-taxable unless you have over $500,000 gain. We had a fellow the other night worried about that. I told him not to worry about it. A like kind exchange. But now, we may have gains on any of these, and we have to report them on taxes. All right, what is a like kind exchange? Now, if I trade you this little laptop for your cell phone, does that sound like a like kind exchange? I don't know. That's a hard one to call. If I trade this little laptop for your home computer, that would be, do you have a laptop? If I traded one for that would be a like kind. But now, anything to do with computers. So telephone, even though it's almost a computer, now stock for stock in the same corporation, but it cannot be stock in Ford for stock in General Motors. A cow for a cow is like kind, but a cow for a bull is not for some reason. Okay? Now look at this one though. You know, you didn't think that cell phone, but you can trade an office building in the city for a farm in the country. But if they're both used in the taxpayer's business or as an investment, it's a like kind, okay? They'll be in the same class, real property. You can't trade a farm for stock. Real property, office building and a farm are both real property. You can trade a car for a pickup truck, okay, if it's business property. Now, holding period starts when you bought the property you traded. Property that is not like kind. You see securities, currency. Wow, that's crazy. Can't trade gold for silver. And here it says livestock, bull for a cow. Here's some direct like kind exchanges. All right. Here we got property A and B, and here we got Steve and Lena, or whatever her name is. Before exchange, I guess Steve owns property B, fair market value is 150. But his adjusted base is only 85. Her farm value is 150, her adjusted base is 110. Now they're going to exchange property A for B. Now, after that, after exchange, carryover basis is the same as property A, and his basis is 85. Now, her carryover base is the same, her base will be 110. You didn't have a gain or a loss, but your basis stays the same as the property you traded. Don't worry about the three party yet. Now, if you get boot, cash may be part boot or all boot, but if it's boot, sometimes you're taxed on it. You take over a transferor's liability, that's the same as giving him cash. The gain is recognized if you get cash boot. Right, basis of property exchange, say $1,000. And let's say you received boot of 200. All right. That'll reduce your basis down to 800 on any property you received. Gain recognized, less loss recognized. Anyway, this picture don't make much sense. I'll have better examples later. Changes between the related parties. Unrealized gain is recognized by original transfer when between related parties. So you don't get this like kind of exchange between related parties. All right, now involuntary conversions. How do you lose something, Hillary, involuntary?
You have it seized.
What?
You have it seized.
Seized? Well, these druggies have property seized, don't they? That's where they thought Trump could build his wall out of drug money. If it was seized, okay. Floods causes involuntary conversion, don't it? Fires, hurricanes, tornadoes, whatever. So acts of nature cause involuntary conversion. Acts of nature. All right. So let's go on and look at that. Now, the only other thing I think, sometimes a state, okay, the electric company can run utility poles across your land. That's called eminent domain. Now, these people down on the border, they may not want to give land for a wall, but the government probably can take it through eminent domain. That's involuntary conversion. They may or may not get money, but the government can condemn your property. And I taught at Garden Elementary, Garden High School for a while, and they condemned property to build the new Garden Elementary School, which high school at the time, but now it's middle grades. Government can condemn your property. Factors causing involuntary conversion. There's the old theft, destruction by acts of nature. All right. Now these three, seizure, these druggies get a lot of property seized. Their cars, their four-wheelers, their pot, even their cash. The government can condemn your property and build a school on it, or a hospital, or a road. A requisition, I don't know how they'd requisition your property. You got a loss, you take it now. If you got a gain, you might be able to defer it.
They condemn your property. If they pay for it.
Good question, Hillary. They should. If they take an acre of your property to go to put school on, you know, they should pay you the fair market value. Now, but they may not have to pay you to put a gas line across your property. It's not in your deed. Or if they put telephone hot wires, telephone, electricity, and TV. They can put those across your property through rights of eminent domain. Not pay you a dime. Now, if they condemn my property where I live now because they want a 4-lane highway, which they wouldn't, all right, they want to put in 2 more lanes. Okay, condemn my property, putting in a highway, yeah, you should get paid for property that they condemn for a highway or a hospital or a school. All right, is a triggered when there is threatening or actual government condemnation. Now, if they just threaten to condemn you, I wouldn't take it as condemned until it carries through. We'll look at this later too. If you have a gain realized, pay taxes on it. No, wait a minute. Sorry about that. Gain realized may not be gain recognized. You may realize $10,000, but you only have to recognize 5 of that until you sell it. Sale of your principal residence. All right, up to 250,000 single, 500-mile fire joint. So, Hillary, you'd be married fire on joint, wouldn't you? All right. If you own a home, if I own a home, what have you, it's hard for us to sell a home we own and get a gain of 500,000. I mean, let's say you paid 100,000 for a home. If you sold it for 600,000, then 500 of it is tax free. If you sold it for 700,000, you only pay taxes on 100. That's a good deal on the sale of a home, isn't it? That's got to be your personal residence. You got to live in it 2 out of 5 years. Now, also, it could be a boat. It can be an old school bus fixed up. Whatever your home is, it can be a tree house. It could be a cabin. It could be a camper. Any of those things can be your principal residence. Two out of 5 years, you got to keep that. All right, we'll get back to some nitty gritties on this later. And here we have a form we'll look at, gain on sale of a home. Even a home being involuntary converted. All right, that's a fast look at that chapter. And that's all we're going to do today, Hillary. And I appreciate you being here, I really do. And we're going to call it a day. So now you've got to read chapter 11 and chapter 12. And start on some even exercise in 14 and 11. So you do have a lot to do, folks. So try to do what you can. I hope I didn't cut these people off. Well, here we are. For a minute, I thought.